And we are live, live, live. Good morning to everybody. Good, have a wonderful day. Hope you are. And to my co-host and co-pilot, brother Vernon Stiffy, how are you doing?
Brother Vernon Steve sounds yakuchechi.
What would you prefer, Reverend, Apostle? What would you want?
Ilifia bwino, ilifia bwino ba munina, ilifia bwino.
How's your day going, Vernon?
It's beautiful. It's fantastic so far. I think we are enjoying how things, of course, are panning out so far today, being a Tuesday and whatnot.
And a welcome to everybody who's with us live on social media, and also those of you who are listening to us live on radio. Thank you very much for joining us. We are here to take you through your morning bite sizes of how the markets are doing, and we will be opening up first with the market. We'll be opening up first with market data, going into a bit of some deep dives for the day, and then we'll be going through our topic of discussion, which is for this month. I'm going to be talking a bit about something I don't about that. We did just get a bit of a hang up there. I'm going to be talking a little bit about insurance so that we can actually cover it because I've seen that a lot of people have got a lot of vagueness in this area. And for the purposes of financial planning, it is something that is quite important to your plans and to your needs. Now, let's get into today's market. It is Finance Tuesday, and let's break down what we're going to be talking. As we said, for the next 6 weeks, we'll be going through the world of insurance. Try and break it down. First, let's get down to the markets. We find out that the kwacha is up. The dollar is up another 0.44%. 31 days we've lost value on the kwacha consistently. So this is one of those tough runs that we've been seeing. 1.69% up in the last 7 days, 10% up over the last 30 days, and 9.42% up in last month. The dollar is a buy on technical and on fundamental terms until we see a change in the debt restructuring. We did see that the stock market did drop yesterday by about 0.55% due to 6% decline in Chilanga Cement shares. We're on the week; it's down it's up 0.51%, still up 11.6% on the year. We also did see that the bond market was up 0.16%, but also in dollars down 0.29%. You can see the difference right there between the dollar and also index, and we did see interest rates come down for the second day in a row consistently. So we are seeing a little bit of buying happening on the secondary market of the bond market, but interest rates are still elevated for the year. So we are looking, as I said, the rand has pushed back over one. Remember that the rand is back to being stronger than the kwacha. So cross-border trade do expect a little bit of inflation over the last 30 days. We've seen 4.79%, 4.79% devaluation of the kwacha against the rand, meaning you should expect some rand inflation if we're seeing products coming in from cross-border trading activities. Those people who hop on buses, go and grab things, come back to bring them to sell, they're going to find them a little bit more expensive. South African inflation is still a little bit sticky. While on top of that, you now have a stronger rand from obviously interest rate hikes that are happening, but the rand is still down year to date 4.13%. So we can see that across both main currencies, dollar and rand, Zambia is facing a little bit of a beating here. As you're seeing, as I said, that interest rates have bumped up a little bit back from where they were. We dipped down to about 24.02, back at 24.12, meaning there has been some sell off over the last month. In terms of interest rates, and you can see that the sell down, the loss of value has also been happening in the GRZ bond index internationally. So year to date, bonds up 11.65%, while you're seeing that the GRZ bond index in dollars is up only 2.03% due to the strengthening of the dollar against the kwacha, and year to date interest rates are up 0.48%. So we're still having that stalling session because we're waiting for a debt deal to happen. You saw the president yesterday did actually meet with Chinese ambassador to Zambia, but still we're not seeing where this is going yet until we actually get some tangible moves. The market is going to be in a rather defensive position. So this is why I keep saying you shorten your horizons, make sure you're stockpiling in the shorter part of it, always be buying because these things generally do turn around. Now, the commodities market, we did see yesterday that oil was up 0.95%. Copper was up 0.95% as we saw tighter supply, but there is some negative news around copper. Oil was up 1.42%, mainly due to the news on Saudi Arabia taking harsh taking measures to cut oil barrels down. We'll be talking about that later. While gold is up 0.42% as America is still in choppy and dicey territory after they kind of navigated through the debt deal. Remember, yesterday was supposed to be the day that America was supposed to run out of money. That there has been some replenishing of reserves that is going to start happening very soon. Some also news that we're also seeing here in terms of copper, as we said, copper is expected to soften in price a little bit. As you can see, inventories in the LME did push up to the highest. You saw inventories fall to an 18-year low in April 2023. And so therefore in May, that final graph there, you can see inventories jumped up by 56% in that single month alone. So that was mainly due to the fact that there has been a strong push up in terms of oil inventories. Now, what we're still seeing is that LME futures contracts, therefore, have started to come down to the lowest that they've been since last year in June. So that's a little bit of activity there that's actually pushing up some of the copper prices already. We're also seeing in terms of other commodities, just so everybody can keep an eye on this, coal. Coal is quite important because it affects cement prices because it's used in the kilns and everything. I just wanted to leave this as the final chart before we go on our break. But as you can see, coal supplies and inventories are going up, meaning that coal prices should start coming down. Therefore, that should also put a bit less pressure on the energy required for imports of coal that go into cement production. So that's something that we should pay attention to as well. We'll be back on the other side of the break to talk about our wealth insurance assets and also to break into what our deep dives for the day are. But our commodity markets are also showing a little bit of a rebound after all that scary hoopla that we were seeing of recession talk from America. But once again, Vernon, catch you on the other side of this.
Thank you so much for still staying tuned to Money and of course Business for Breakfast still today. Hi there.
Good morning and thank you all for coming back. And yes, let's get back into where we were. We were talking earlier about coal prices Now, remember, one of the biggest things companies like, let's say, Lafarge have always pointed out is that coal prices actually affect the price of cement that you get. It's gypsum prices from what they have to import, but also coal prices. Remember, coal prices were sitting at were up 280% last year. So this amount of coal that's sitting in reserve now, thanks to China, will actually now start to reduce the prices. So domestic railway cargoes add to inventories while imports grow. So stockpiles of coal have now hit a 3-year high. Obviously, with the prices as high as they were, people were basically now they were extracting it and they were preparing it. So you now see that price of coal will start to come down a lot more as we face it, as we go into the session. So that will affect all those things that do need coal, things like I said, like cement itself. Wealth insurance assets that we've seen, Bitcoin was down 1.2% in Kwacha versus Ethereum that was down 1.6% and gold up 0.87%. As you can see, cryptocurrency back down again, but still up 76% year to date, but down 0.2% on the month. Ethereum up 3.15% on the month, while gold is up 7.92% on the month. Remember, these are your wealth insurance assets, things that you can use as the just in case the financial system burns down and people have to switch to a different thing, kind of assets. And these are part of them as well. People use commodities, people use all sorts of things. You hold dollars for those reasons and various things. So now if you look at yesterday's holdings of the year-to-date interest of the year-to-date returns on investment, we are seeing that in real terms, bonds are up 4.9%, stocks up 4.9%, dollars up 2.7%, and gold is up 11.5%. This is just obviously a sign that the market is still in a very defensive position, trying to figure itself out for the period. So this is why I said that you don't go all in on these things because you're seeing such high returns on investment, but you do put partly in them, obviously, to level out just in case. And then one of the questions I get asked about how do you utilize these things? Well, if you ever have, let's say, that 5% of your portfolio, 10% of your portfolio in these wealth insurance assets, as I call them, when the prices do rocket up the way they do, you don't, if it crosses a certain threshold, like maybe 7% or 10%, you sell it back down to 5%, and then chunk that money back into your, let's say, your bonds and your stocks, so that this keeps your portfolio balanced. Okay, this kind of keeps your whole portfolio in a balanced situation, because the reality is these are very volatile assets and you don't want to have too much of them. So you always want to try and balance out the risk by taking from them. So we call that taking profit. Okay, one of the reasons why these things tend to not work sometimes is because people don't actually do take profits whenever you see prices of things go above their weighting. This is why we rebalance portfolios consistently, and I'll talk about that activity sometime when I'm going through the investment activities for people. Now, also going into some of this, yesterday we did see our four horsemen outlook. Swiss inflation dropped to a 14-month low, 2.2%. Turkish CPI and PPI dropped to a 16-month low and a 2-year low of 39.6%. Yes, Vernon, you're not seeing things. 39.6% is the 2-year low for Turkish inflation. I have no understanding how Erdogan got re-elected under these conditions. I am struggling to what was there no one running against it? Like 30% inflation should just generally move you out. But maybe, look, the reality is probably the Turkish people are just probably used to this. But you did find the President Erdogan got re-elected, 40.76% reduction in PPI. So you can see that inflation pressure is coming down. European Union PPI also, in other words, the inflation of their supply chains has come down to a 27-month low of 1%. So we're looking at early pandemic levels here, when inflation was almost non-existent. South African PMIs have also dropped, meaning deeper into contraction, meaning that South African production is starting to slow down again. The private sector is down to the slowest it's been in almost 2 years. So all the momentum that built out of the pandemic has started to curb back against South Africa. US short-term interest treasuries auctioned a little bit lower. That's some good news. However, European investor confidence came down to a 6-month low and has been negative for 15 months. So this means that as you're trying to reorganize your debt, the very investors you need to buy your debt or your bonds to try and reflate your currency or strengthen your currency, they're currently having very low investor confidence at the moment. German exports rose by 1.2% and imports fell by 1.7%, pushing German net trade up at 18 to 18.5 billion. That was surprising good news. Japanese spending data was still waiting on that information, while UK, US, and European PMIs dropped lower, but still we're seeing that this is based on services. Manufacturing is where the problem is in these areas. And also other news is that US factory orders growth was negative except for transportation. So we're seeing weak data coming out of the industrial sector. We're seeing growth still fragile. We're seeing investor confidence down, though interest rates are coming up. But we are seeing inflation globally still coming down. So one of the big signals we're seeing that's consistent in the news is that global inflation is slowing down. That is the main thing. So importing inflation may not be an issue. The problem is we've got a weakening currency in a financial situation. So whether we will feel the benefits of this is a different story. So let's get into some of our deep dives, Vernon, on the news. We did see that some of the news published on Money that we did see from our Money FM team is tighter lending standards in U.S. regional banks make it harder for hotels and developers to access capital. And this is at a time when travel demand has actually been rapidly rising. It's handicapping these people from being able to build out new hotels. Now, why is this important? Slowdowns in construction loans will slow down construction, which slows down demand for copper. So remember, copper is important in construction. So when you're starting to see this kind of a problem, it then has a ripple effect all the way back that starts to slow down demand for copper. But remember, the big driver of copper demand is still electric vehicles for now. That's the growth spot, but still the biggest use of copper is construction. And as much as EVs are the fastest growing part of the demand for copper, it's still not the number one use. That is construction and infrastructure. That is where copper majority ends up. So when you're having less hotels being built, less lodges, less resorts, that's less demand for copper, especially in America, one of the biggest markets that is needed for that. So that's one of the biggest stories that you're seeing, that the spillover into regional banks is now slowing down hotel production, even at a time of demand. We're also seeing that U.S. big banks could be required to face a 20% increase in capital requirements. Now, there has been strict requirements. This is mainly, they're considering that stricter capital requirements could be required to make banks more resilient against bank runs like we saw with Silicon Valley Bank. Now, the banking regulators have already been exploring increasing capital requirements. Now, if you increase capital requirements by 20%, that means there's going to be less that can float around. Now, we're relying as a country on these big banks from the US to come in and buy our bonds when we sort out our debt issue and when we get re-rated. But now, if they've got higher capital requirements, that affects their ability to now send capital into Zambia. And therefore, your bond auctions start to get hampered a little bit. Now, that doesn't mean they get cooled off, but this is a sign that we may be re-entering back into a very tight financial system going forward, where interest rates may be elevated a little bit, banks may be constricted to their lending. So we shouldn't think that this is going to just be business as usual. It does appear that there's a reformation happening in the global financial system that might affect the outlook of having money flooding back in. Now, that doesn't mean no foreign capital will come into our bond market once we sort this out. It just means it may not be as much as we expect should things like this happen. But remember, this is just on the table. It's just that the Silicon Valley Bank situation has presented a positive argument for it. We also did see yesterday that Brent prices jumped on news that Saudi production cuts for June. We saw yesterday Brent prices were up 1.42% and up 6.21% since the beginning of May. Now, this poses a threat. These price hikes or these production cuts may pose a threat to sustain Zambian pump price declines for the last 3 months. So if we start to see prices of oil going up, that might affect our ability to sustain lower prices of diesel, lower prices at the pump. Okay, so remember, global prices are very important. So you're seeing Saudi Arabia saying they want to cut production by 1 million barrels. The rest of OPEC was not interested. Russia wasn't interested from OPEC Plus. Everyone was saying it's fine. Saudi says, hold my drink. We are going to sort this out ourselves, because they want to protect their price, because they want to diversify. Saudi Arabia sees this as the final decade where they can make as much profit as they can from oil. So they are literally trying everything they can because they need to take out as much profit and then re-diversify, because the demand for oil probably going forward will start to drop as EVs become a larger chunk of the vehicle market, especially the new vehicle market. And because EVs will become a larger chunk of the new vehicle market, eventually they'll start to roll over and become a larger chunk of the total vehicle market. But that's obviously a 30-year game. But yes, they're thinking 30 years ahead and trying to make sure that they can sort out all their profitability now and not have it catch on to them. It's not our fault, people, that it's not our fault that we think only 1 week ahead while they're thinking 30 years ahead. So that's some big news coming out of there. So in the interim, you may find that the drop in pump prices we've been experiencing may reverse course, especially on the second half of the year, if the Saudis decide that weak Chinese data is going to be enough for them to go hard into price cuts. Into production cuts to try and lift back the price into the 80s. Also, data that we did see yesterday was IATA. There's the IATA Global Conference happening in Turkey right now. And we did see that airline profits globally are probably set to rise to $10 billion in 2023. This is doubling the estimates earlier, mainly due to North America and European price tickets going up. So it's the flyer miles are up, but the ticket prices are up. Now, obviously, the rest of these, we have seen that Asian airlines are not going to be as profitable. African airlines are also going to be loss-making to the tune of about $500 million. But we are seeing that there's going to be strong profits coming out of U.S. airlines and also European airlines. Revenue for the year is expected to be $803 billion, not as high as 2019, just a little bit lower, while profitability still remains way below the $26.4 billion of 2019. So the airline industry is recovering. It has not fully recovered. But this is signs that we are seeing activity happening. And here's some of the estimates that we did see from IATA so far, the International Air Travel Association. North American net profits are expected to still remain around $11.5 billion, while it was the Europeans who have gone up from $620 million of projected airline profits to $5.1 billion of projected airline profits, mainly because of air ticket prices. As you've seen, the Asian airlines are expected to go from $6.6 billion of losses, $6.9 billion of losses. Middle East is also going to experience a very bad situation. Though there's 38% more travel, they're expected to make $2 billion of losses this year, while Latin America is also expected to double. Africa also is expected to have losses going as high. The earlier projection was $213 million. Now it's $500 million that African airlines combined are expected to make losses of in this year. So all the profit growth is really expected to come from the fact that the European industry has really reflated. European travel has really gone up. And this is this whole revenge travel story that we've been seeing around happening. Now, Vernon, let's get into the conversation of our chart of the day. Yesterday, we were talking about people withdrawing from their pension funds. And this is a chart that shows from the Pension and Insurance Authority data from 2013 to 2022 that shows you what percentage of contributions in money that's meant to go into investment is being withdrawn by people who are switching jobs and leaving. Now, remember, this number was sitting around 28, 25, 24%. Look at that in 2012, 2013, 2014. Now, take a look from 2015 onwards, especially 2016 when we had that constitutional amendment. Now, two things happened. One, a lot more people were losing jobs. There were huge job cuts that have started from about 2016 onwards. Okay. Two, now people were allowed to withdraw their pension tax-free. So before 2016, the law, Vernon, was that you could withdraw your pension, your part that you've contributed, you could withdraw tax-free, but the part that your employer put in, they taxed it at top rate, 35% back then. Okay, so if you, let's say, had 200,000 kwacha in your pension, you could withdraw it. You could withdraw 100,000, yours, but then the 100,000 that came from your employer, that part you'd only get about 65. Okay, so tax 35% tops rate on it. Now the law now kicked in and said nobody gets taxed. now. Before, gratuities, all these things, they used to get taxed. Now the law kicked in and said no one gets taxed now. Okay, no taxing at all, and a person must be paid their pension on the last day, or else the employer will incur the cost of keeping that employee on the payroll. So two things were added: tax removal and a punishment for employers who were delaying on payments to employees for their pension. And what did that result in, Vernon? A spike, a massive spike that we have seen in pension withdrawals from 24% to 50 to 61% of what's it of contributions. So job cuts mixed with pension data that allowed for all of this has now created a situation where money is struggling to stay into the pensions. Now pensions are growing very well still. The pension industry has experienced some strong growth, mainly due to good portfolio managers, good return on investment, but they've been handicapped by the fact that so much of the contributions coming in are leaking out. So basically, Vernon, for every 2 kwacha put into a pension fund, 1 kwacha is being withdrawn, okay, by people who are now want to go and use. Now, what percentage of this money ends up being invested? This money ends up being chewed. So this is why I said one of the biggest temptations people are facing in yesterday when I said mentalities you need to do away with if you're going to go into wealth building is withdrawing from your wealth accounts. You cannot build wealth if you keep taking money out. You can't do that. It's very difficult. You build wealth by keeping money in there, and the proceeds of that wealth is used to purchase more assets. That's how compound interest works. It's when you use the proceeds of assets to purchase more assets. You use the rent from your flats to build more flats. Okay, while also using your savings to build more flats. It's when you use the coupons from your bonds to buy more bonds. When you use the when you use the dividends from your stocks to buy more stocks. That is how compound interest works very well in the markets for everyone. So this is a data that's showing you that our discipline levels as a country when it comes to withdrawing money is pretty low. And yes, we can say the situations are pressure. Yes, you are in a high pressure situation. But when you finish that money, what's going to happen? Is the pressure going to go away? Most of your pressure you're talking about are things that you engage in on a daily, weekly, and monthly basis anyway, Vernon. Okay? So at the end of the day, what does it mean if we're saying that it's just pressure, it's the pressure situation? It's not. So before we get into our before we get into our main chat for today, we're going to be talking about insurance. Vernon, let me catch your thoughts on this. What are your thoughts as we're talking about here on our evident withdrawal culture?
It's good that people actually are able to access these monies for starters, and ultimately, I think it was a good move. If you ask me, giving them
Is
some
it?
cash so they can have what they have to and what they need to. I think it wasn't a bad idea. But moving forward, what they decided to do with the money though is what become. I was actually at Leavenmore yesterday in the afternoon, and I saw people lining up and sitting like they're almost hopeless, but they've got a bit of some hope. Like anyway, at the end of the tunnel, we'll still be able to make it inside the office and maybe have the procedure done. But the line was moving. At the end of the day, and for me, what really came to my mind is. How much we want to use the money. Quite okay. Some people, have some sensible things that they want to push the monies into, and I was telling one of our relatives also has an upside account and has some chunk powder for them in there, and they were telling him how do I access it, and it's great. And so I was like, this is your money, yes, but I will advise you that you calm down about it. Give yourself a few more months when the whole situation comes down. Your money will still be there, and ABSA will still hold on for this long. They've held it on for you, so just hold on. This time, use it to plan for whatever you want to put the money into. And by the time everything now comes down, there are no longer long queues. You can go and withdraw your money. Would have come up with a sensible structural plan that it's going to be able to withstand and be able to thrive at the end of the day. Right now, you want to withdraw money because the money is available. But what are you withdrawing the money for right now? And it's like, but my pressure and Congolese, and like, no, right now you can manage the way you've been managing. Just put in for another maybe 1 or 2 months. When everything settles down, you're able to withdraw your money. And by then, devise a plan that's going to be, something that you can push those monies into. Unlike where you withdraw and then now you start thinking about the plan. In the process, you end up spending money on unnecessary things and to just be another one of those things where I once had money. I once had the 50,000. I once had the 30,000. And what did you do about it? What did you do with the money? Nothing. So the spending and withdrawing culture is great. And I think this has escalated, and people seemingly are not aware of this. If you go to malls, if you go to marketplaces, the one thing that you always find there are ATM machines, very available 24/7 for you to withdraw your money and spend it on useless things. Those things are always available. But they even give you credit cash. It's fast money anywhere, and they make sure the ATMs actually are working and loaded with cash. So if you are always rushing to the ATM for conveniency, your spending culture is not really, structured and understood. I was talking to a lady. She was telling me, this is why I don't like carrying money with me, because each time I pass through town and I have money, I buy things I didn't even plan to buy. I was like, that's something you've identified there. That's pulling you backwards financially from away from financial freedom. So start taming these things. If you go to town and say, I'm just going to meet somebody and come back, or I'm going to buy this and come back, do just that because you've planned for it. And at the end of the day, you end up spending money on unnecessary things that should have been able to help you save and invest. And also, she was quite open, and she told me that she's been wanting to save money, but each time she saves, and she saves for just in case an emergency comes, she ends up always using the money even before an emergency comes up. So I told her, create a plan that is going to really hold you down when it comes to saving, a real plan, a real reason why you're saving. But if you're just putting money aside just for the sake of, tomorrow morning you're going to withdraw the money and spend it on whatever. So I think the spending culture and the withdrawing part, I think money is there. Accessibility is just fine, it's okay, but why do you want the money? Just the fact that it's available and it's accessible doesn't mean you should have the money. So think about what you're going to spend the money at, and you will have a reason just to either withdraw or have the money, or just keep the money. I would have given a very practical example on this note, but it's for later.
Vernon, not spending money can be spiritual warfare, my friend. Have you seen what people go through to not spend money? Like, first of all, we are tempted every single day to not to spend money. We are tempted every single day. Every chance people get an opportunity, we are tempted. So I'm just telling you that it's almost spiritual warfare trying to stop yourself from spending money. You walk into the shop, there's a special. Just when you've told yourself, no, today I'm just doing this. Today I'm only buying this. Just the day you've decided that no, I'm resisting, I'm resisting. That's when the most irresistible things start showing themselves to you. But I'm just saying that's a thought for everyone. But anyway, the point of today I was trying to point out to people is, if you want to build wealth, you actually have to keep money in things. You have to keep money. Remember yesterday we said one of the mentalities you have to part with is putting money in things for show instead of things that grow. Okay, so that's something everybody should have kept in their mind. Keep your money in things that grow, not for show. Because the truth of the matter, Vernon, is the majority of things I always tell people, if you notice how flexible the word need becomes, when all of a sudden you have the opportunity to, or you have a lot more money, have you noticed that the things you need start to grow in number? The word need now starts to grow in meaning. You start to say, no, but I need that specific brand. It's not even just that you need that specific thing. You now need the specific brand. It becomes a need. So you have to be understanding to what your weaknesses are, what are your temptations, and also to make sure that money has a plan before it hits your hand. Because if it hits your hand without a plan, it'll find a person with a plan. Okay, money is a very fickle thing, people. It'll find a person with a plan, and then you'll be there wondering, but how come money just left me like that? Because it's looking for a person with a plan. Now, Vernon, our big conversation for today, our big talk today is going to be about insurance. And I really want to open this up because I talk a lot about investment, but part of a good wealth portfolio is also understanding insurance. Now, insurance is a bad reputation, but it's got a really bad reputation because everybody kind of sees it as nothing happened, but I put money into insurance. Why? Because I was scared. But I always tell people insurance will always seem like a scam to you until the day you need it. Okay, the day you actually need that insurance, in help putting money away for health insurance or anything, you're like, this is a scam until you go to the hospital. Putting money away for car insurance is all a scam until you're in an accident. That's what people need to understand is that it's because there are things in this world that are outside your control, and we're gonna have to talk about how to handle the things that are outside of your control and how to basically deal with risks themselves. I'm going to talk at length for the next couple of weeks, or not for the next couple of weeks, for about 6 weeks about that, so that you can understand it in depth. I'll be going to the different kinds of insurance, but I actually want to introduce this. Now, I'm not a full right insurance person. I'm more of an investment person, but I understand the role that insurance plays in one's portfolio and also in one's life. Okay, because insurance helps protect against the disruptions that prevent you from building of wealth. So if you look at insurance with that negative, everything is a scam mentality. Remember what I said? Another mentality you must do away with is thinking everything is a scam. And now because you're making decisions on fear, you're making decisions on emotion instead of making decisions on principle. Let me get the insurance that I need that is particular to my situation. Is this relevant insurance? You shouldn't be looking at insurance as to whether you think it's some conspiracy theory scam. Look at it as, is it relevant to my situation? If something happens to whatever it is it relevant to my situation? So as I said, today we're going to be talking at depth in the discussion about insurance. Now, I want to go back to this graph, Vernon, where I told you that there are your aspirations in life are to live a legendary life, a life well lived, where you live out the purpose of your life, your dreams, your aspirations. You leave a legacy, what you leave behind for others to benefit from or build on, be it buildings, projects, businesses, institutions, assets, business systems, inventions, ideas, memories, things you want to leave, your mark, the physical part of your mark that you've left behind, and also your lineage, who you want to leave behind to benefit or build on. In other words, this is a moral and competent people to continue your work and your name. So this is the life well lived. You'll say in your life at the end of the day, this is your life well lived because I lived a legendary life, I left a legacy, and I left a strong lineage to continue things for me. Now, after this, we have to then have financial freedom. So what is financial freedom? Financial freedom defined is freedom from worrying about your basic needs, freedom from worrying about your loved ones, freedom to allocate your time to pursue meaning, and also your mind. You want to have a free mind. Worry, Vernon, is a very dangerous thing. Living a life where you are constantly worried and under pressure. No, worry causes deep BP, people. Like just that BP that comes from stress. Okay, that's what you're trying to avoid. And then freedom from chaos and disorder from disruption. So you want to be free from disruption that happens to your life. So you don't want any sudden disruptions. So where does insurance play? You want to be free to, remember that the third pillar frees you to pursue these three things. It frees you to pursue a legacy, a legend, a legacy, and a lineage. But in order to have that freedom of your mind and your time, because Vernon, you can have free time, but you're in constant worry. Okay, you are constantly worried. That's not freedom. Okay, unemployed people have free time, Vernon, but they're worried about food. In jail, it's actually following them every day. So that's a reality. So you want to make sure that as you've freed your time, you've also freed your mind. And that is the point of financial freedom. That's the point of building up assets. But it's also to make sure that in the event something happens, it doesn't wipe you out. It doesn't destroy you. So you're really worried about pillar 4. Okay? Pillar 4 is freedom from a life of chaos and disorder brought on by disruptions, unforeseen disruptions. That is where insurance comes in. Okay? It is the thing that you can do to try and manage it. Now, you build up assets to also defend against the uncertainties of life, but you can also take out insurance to also help against some of these uncertainties of life. Now, remember, you are trying to hit your goals. So you're trying to allocate as much capital, as much of your income to things like your harvest. You're trying to build your harvest, which is your retirement savings. But Vernon, how can you do that? Okay, say you're driving, you have a car accident. Now, how can you put money into your harvest when you have to fix your car? It was uninsured. Okay, now you have to take money out of your savings, which you've been doing to build your savings, to go and fix your car so you can get back to your daily routines and everything. So now you've disrupted your savings. Okay, your health is important. So now what happens when if you don't have health insurance? Now you start bucketing out your savings to save your life. Okay, so you can't reach your financial goals. Your children's education is at hand. So let's say you're saving for your children's education. You pass away when your child is 8. You've only done a certain amount. Now, who's going to be there to finish off your child's education? Once again, you see, this is a situation. You did not insure against the loss of your life, your loss of your abilities. What if you ended up having a disability? Okay, what if you end up you losing your ability to walk? Are you then able to continue saving for your child's education? So this is why you have to start looking at insurance. Home ownership. Vernon, you own a home. You've built this home. You've put all this money into your home. And then one day, one electrical wire goes loose and poof, your whole house is gone. 400, 500,000 kwacha worth of building expenses, materials. You've been saving for 10 years to build this house, and just one fire in one day, and your balance sheet, your house gone. Why? Because you didn't insure your house. Okay. So you have to start looking at insurance as the ability to steadily pursue your financial goals that allow you to reach your financial freedom and give you the freedom to pursue that. So the purpose of insurance is for peace of mind and for freedom from disruption so that you can do this. Because the problem is disruptions in life always send you back. Okay? How many people, Vernon, health issues have drained their savings? How many people have seen that? A health issue, because it's a life and death issue, has drained their savings. Okay, so that's what you have to understand. The thing that protects you from being able to reach your high 5 goals, your harvest, health, higher education, home ownership, and huge purchases of investing to reach your financial freedom. Because once you've touched these 5, you are free. Your brain is free. Your mind is free. Your soul is free. You can now go and pursue. The only problem people have, Vernon, is they've got nothing to pursue. They didn't think about what their life vision is and think about anything else. So because of that, they don't have a reason to be free. So therefore, they go into self-destruction. But those who have a reason to be free, this gives you that mental freedom to be able to do that physical, financial, and the mental freedom to be able to pursue that. This is what we're all looking for in life. Okay? So one of the things I wanted to try and give you an object example of is this. And Vernon, everybody today who went to work or woke up this morning and probably used a vehicle of some sort. You probably jumped in a bus, or you probably drove a car to get to where you needed to. I'm correct in assuming that, right? So the question is, every time you jump behind a car, do you take into consideration the probability that you could actually face an accident?
Absolutely. Every single time
Now,
you're on these things, yeah, that thought hits you.
now, do you think for a second, what is that probability? So I've worked out an estimate, okay, based on 10 years of RTSA data on road traffic accidents and vehicle populations. And here is the stat that you should be able to have in your mind whenever you do this. Now, I want you to understand something about an accident. A road traffic accident puts 3 things in jeopardy. One, it puts your vehicle in jeopardy because your vehicle will be damaged. 2, it puts your life in jeopardy because you could die in there. Okay. And remember, Vernon, your death is not just about you. If you have children, you have people who rely on you. If you have a spouse, you have someone who relies on you. You have family members who are depending on you. If you have people who depended on you, okay, so you have to ask the question about if I was to leave this earth, who would be in trouble? Who would have an issue? Okay, who would struggle to eat? Who would struggle to live? That's why you're talking about, when I go back to financial freedom, remember I said the second pillar of financial freedom, and I just want to come back here, is freedom from worrying about the well-being of your loved ones. Okay, now everyone thinks about that while they're alive, but what happens in your passing? Okay, what would happen if something happened to you, to the people who depend on you? So every time you enter into a vehicle, just remember that your life is also at risk. And even if you survive, Vernon, there's a possibility you may not have the physical capabilities that you have. Okay. You remember, have you watched the movie? If you watch the movie Get Rich or Die Trying, the story of 50 Cent, when he gets shot in the mouth, they said they had to try and heal him because one of the bullets, like I think, hit his throat and he wasn't going to be able to talk. And think about it, this guy rapped for a living, all right? So that was his means. So what happens, Vernon, if the accident takes away not your life, but takes away your abilities? What happens if that accident takes away, let's say your hand has to get cut off or something, and then all of a sudden you are a carpenter and now you don't have a hand to make a living? So these are the questions you need to bear in mind. So what is the probability you're facing? So after 10 years of RTSA data, I looked at vehicle populations, accidents, and fatalities. And I came up with a rudimentary exercise to tell you that every year, a vehicle has a 4.5% chance of experiencing an accident, while while a vehicle also has a 0.31% chance in a year of experiencing a fatal accident. Okay, so think about that very carefully. It has a 0.31% chance of experiencing a fatal accident. So, in a life, Vernon, of 50 years of using a motor vehicle, you have a 1 in 6 chance of dying behind that wheel. Okay, or being in a public service vehicle, you have a 1 in 6 chance of dying behind that wheel in your lifetime. This could be the day, it may not be the day, but you have, and after 20 years of driving, effectively, Vernon, you are probably, or being in a public service vehicle, you have the probability of experiencing at least one vehicle accident in your life. Okay, you have the probability of experiencing at least one vehicle accident in your life, be it in a public vehicle, be it in a private vehicle. So when you go on a bus intercity, when you go on a bus to work every day, when you jump into the back of your car, when you move every day. Now, obviously, some people are higher risks than others, maybe alcohol consumption on Saturdays and deciding to go out all night, those kind of things. Some people are higher risk, like men, for example, are higher risk than women for experiencing car accidents simply because we drive more and we also drive drunk more. Okay, way more. Like we drive drunk way more. Okay, so those are the things that obviously do factor that in. But take into consideration, Vernon, that the reality is that these are the probabilities. So every time you sit behind the vehicle, you sit behind this vehicle, just know there's a 4.5% chance this vehicle is gonna there's an accident happening and your abilities could get lost. And if your abilities get lost, and not just your life, Vernon, your abilities, that means your means and capabilities of making a living get affected. Okay, you can. Um, Depending on the work that you do and what abilities it requires, your means get affected. So that's just one activity that you do every day. There are plenty of activities you do every single day. There's plenty of property that you have every single day. The older you grow, the more things you acquire, the more you need to insure. The more people you have responsibility over, the more you need to insure. So you need to start having an insurance mix alongside an investment mix to make sure that your plans can be fulfilled. So there are two things, Vernon, you need to do. One, you need to insure against something disrupting your plans now. And also, in case something takes your life, you need to ensure that somewhere along the lines, whatever goals you had for the people you're leaving behind can still be fulfilled. My children can still get that education that I was hoping for them, so that my death doesn't end in their destitution. Okay, so that's what you need to try and think about. But unfortunately, Vernon, we take a very, for lack of a better term, we take a very spiritual approach to insurance. I'm being honest. Look, people, I'm a Christian myself, I'm a proponent of prayer, but don't be silly. Okay, there are people who depend on you. There are people who also depend on you. Now, if you got nobody who depends on you, wing it, live on a prayer. Okay, but if you have people who depend on you, if you have things, then it's wise to insure for them. It's wise to plan, people. Even King Solomon said a wise man plans, people. It's planning. Even Jesus says, count the cost, plan these things. Right? So you actually have to plan these things and plan them out and take insurance policies. So one of the reasons why sometimes, now, why did I give the example, Vernon, of a car accident? Now it's got a low probability. You've only got a 0.3% chance of dying in a car accident in any year. Okay, if you're behind the or if you're in a vehicle, it's only got a 0.3% chance that this is the day it's taking you, or this is the year it's taking you. I mean, in a day, you divide that by 360. It's really low. It's like 1 in a 10,000 chance you'll die in a car accident that day. Okay, or that car accident will have a fatality. The problem, Vernon, is that though that may be a small probability, you have to take into consideration two factors when you're dealing with risk. What is the probability it can happen? And then what is the impact if it does happen? What is the cost? What is the thing that I could lose? What could happen? So if you're looking at something that has a small probability, but a huge impact, like losing a vehicle, losing your ability to work, losing your life, okay, it has a small probability, then you may want to take out some insurance against that to protect against it. Now you measure it in a way, and I'll teach you how to go through how to calculate how to kind of get to what a good premium should be. We call this how to measure the risk of loss assessment. But just basically, I wanted to round up, Vernon, into what kind of insurance should people be looking at. The average person should actually be looking at these areas in general. Health, because your health is important. You can't do anything without your health. And if you're uninsured for health, your health scares will bankrupt you. Life insurance, especially if you have people who depend on you. If you've got dependents left in this world, you need life insurance, because whatever plans you have for them and whatever they need from you going forward, if anything was to happen to you, your life insurance policy would be able to kick in and meet those goals. And also, if you have debts that you've left behind for them, you need to make sure that you're not leaving. Remember how there's that old saying by Chris Rock, white man dies, he leaves a will, brother dies, he leaves a bill. You don't want to leave a bill for the people who are left behind. Funeral insurance, also because you want the people who if you lose your life, or if your life is lost, we want to be able to mourn you without having to run around looking for money all the time. Funerals should not be fundraising all the time. If you can work on the policies as well. Education savings, and we'll talk about how education saving can work alongside saving for your children's education and running an education savings insurance policy, how these two things can complement each other and work alongside each other. Property is another conversation we should be having, and automotive as well, if you're a car owner as well. It's very important to have this. But it's also important to understand probabilities. Risk is all about understanding probabilities and impact, and therefore insuring against it. So you must have cash management, which we've been talking about recently. And for the next 6 weeks, we'll be talking about risk management. And we'll be going through these areas. You will want to tune in to understand how insurance works in your budget, in your portfolio, and how it works in your overall plan. And for all of you, if you found any value in that, give us a note, eh? Share with us your thoughts of how you felt about that. Vernon, I don't know if you have any thoughts before we sign off.
No, we're good. Looking forward to the series coming up, especially to how people we react to money, primarily attitudes, and whatnot. I'm really looking forward to those ones. I think I pride personally with personal development. So if we're gonna go down that I'm happy to.
All right. So everyone, have a good day. Vernon, thanks for joining us. All right.
Thanks.